Hello, mortgage fans. I hope everyone's recovered from the excitement of Saturday night. It is very strange seeing the England football team doing really well and disturbingly well as well. I had to have a sort of chat with my daughter. She's 8, and I had to explain to her that this isn't normal. Normally what happens is you go 20, 30 years of lots of disappointment and you get let down at the last minute. So there's still hope for that to happen yet. But she's had this weird existence. So in the last 8 years, think about sort of English sport. She's used to seeing numerous world boxing champions, English football clubs winning the Champions League, endless amounts of gold medals at Olympics. You know, when I was growing up, I remember getting a gold medal in the Olympics was a big deal. And the highlight of my sporting calendar was watching Steve Davis win the snooker. Weirdly, I met him years later, who is a really, really lovely chap, as it turns out. But with all that excitement aside, hopefully we can get through the week. So let's see how that pans out. Back into real life in the mortgage world then. So quite a lot going on as well. The big one is around inflation, and I keep talking about it quite a lot. There is a member of the MPC who is leaving, a guy called Andy Haldane. He's sent quite a few notes of caution saying he thinks inflation is going to go well over 3% this year, could even touch 4%. And that's had a bit of a ding-dong in the press with Andrew Bailey, the head of the Bank of England. The reason being, the Bank of England's stance is to keep interest rates where they are at the moment, which is a historical level low of 0.1%. Mr. Haldane's view is that he wants interest rates to rise to quell the inflation because it has big sort of knock-on impacts in the long term. Really, really difficult dilemma, because if you do start to raise interest rates quickly, you could then sort of knock off any recovery we're having. But if you don't act and inflation sets in the economy, that's going to really strip out both the public and your personal finances as well, and neither are in particularly great shape to absorb that. So it's a really, really difficult dilemma the Bank of England have got now, because in normal times they've raised interest rates, but do they want to do it? Do they want to remove the stimulus they've got in place? Really, really tough call. So as I have been, I'm going to keep a really, really close eye on how that plays out. There was also some really interesting research from the guys at MIAC Property Analytics. They came up with some research that showed that actually the rise in house prices over the last year or so has actually outweighed the benefit of the stamp duty rise. There's quite good research. I'll put it on our website so you can see all the stats. But sort of the bigger winner losers, and it sort of all goes around sort of regional, is very often the case around house prices. But really, really interesting that pretty much every part of the UK now didn't really benefit from the stamp duty holiday, because it just triggered such a huge amount of activity. The rise in prices actually outweighed the benefit. The interesting one that sort of caught my eye, the sort of the big loser, as it were, was the borough of Westminster, where house prices have gone up, I believe, £138,316 in that sort of window. So, okay, great, you say 15 grand on stamp duty, but you pay 130 grand more for a house. Now, I appreciate that's a house in Westminster, so that's not probably a good sample, but it does just show you that London prices being so high, it doesn't take much of a movement to really get those prices pushing on, and that's a big drum I've been banging for a long time as well. So more stats on the website, look up those guys. Actually really, really interesting piece of research, particularly if you're looking to invest in the UK, because the northeast, northwest, these sorts of areas are sort of, will they be sustainable, will they not? Really interesting dynamic as the year plays out. Far more in our world then. So bang on cue, last week I said that mortgage rates can't go much lower, and they have. So TSB have now brought out a rate, I believe it's 0.94%, which has undercut platforms at 0.95% 2-year fixed rate. TSB was just for remortgages only, so platform does remain the cheapest for a purchase. But obviously what I said around inflation and what we're now seeing in money markets, I do stand by the fact that interest rates aren't going to get much lower. They might go down by like 0.01 as they have done, or 5 to 10 basis points. You're not really going to notice that. But I do strongly believe we are in the lowest point of this cycle now. And if Mr. Haldane is right with his thoughts on inflation, the Bank of England can't just sit on their hands. And what tends to happen in the mortgage world as well is that banks will raise their product rates ahead of even the Bank of England moving, or even money markets moving. So if the perception is that rates will be higher in the future, banks will most likely act now, because products are set over a 2, 5 or 10-year period. So what they don't want to lend is cheap money today, and then 3-4 years down the line it looks expensive for them. So that's sort of the basic dynamic in how banks do their pricing. Also LTVs are up as well. The Mortgage Works, which is the buy-to-let arm of the Nationwide Building Society, they're now back at 80% LTV. So that means you can now buy an investment property or refinance one up to 80% of its value. That's previously been 75%. That's now the first mainstream lender to go back into this space. There's been niche players that will do that, but these are the real first big boys to go back into that area. Now, there's really tough affordability rules to make that work. It's not easy, so I'm not going to make out like it's easy, particularly not in London and the southeast. But again, it's possible and it does work. And that normally happens is once one big player does it, other follow suit. So that's a really interesting thing that we're getting back to now pre-pandemic activity, particularly in the buy-to-let space, which sort of got froze out a little bit through COVID. So how that translate into rates then? So the money markets sort of pretty much sort of flattish sort of last week. LIBOR was down by 0.006% to 0.075%. 2-year swap rates up by 0.013, which means they're now at 0.408, and 5-year money was down a touch actually by 0.024% to 0.727%, and the Bank of England held at 0.1%, as I've already mentioned. So how that translates into mortgage rates, I've already touched on the 2-year fix, the cheapest now being 0.94. The best 5-year money is at 1.14%, and the best variable rate product is at 0.99%. Usual risk warning on that is that the actual rate you'll be offered will be dependent on your deposit and your circumstances, but if you have, say, a very straightforward situation, a 40% deposit, they're the sort of rates you're looking at. And again, at the top end, as I mentioned before, 95% rates are coming down. They're starting to settle around the 3% mark, where they were around sort of the 4% mark. So that's quite a significant shift in a few weeks as well. So all looking pretty rosy on that front. Last point is I released a new video last week on bonus income. So if you hadn't had enough of me talking, please look at that on our YouTube channel. Really pertinent point, which I won't do now. Please watch the video. But if you have been paid a bonus and you're looking to use that in a mortgage, banks have all sorts of complicated rules around that. Weirdly, even if you get one, you have to prove why and stuff, which I won't go on about now. But if you've got a bonus, want to use it, absolutely cool. But lender choice is absolutely the key, which is the main point to the video, really. So that's it for this week. Back next week, which I'll probably do on a Sunday ahead of the England game, because I suspect everyone will be hungover celebrating God knows what if the next couple of games go to plan. So good luck to England. Hope you have a good week and catch up soon.